All right, so the bulk of exam one material focuses on things that are fairly marketable and easy to liquidate. And that's something that we tend to not think about when we're thinking employee benefits. We're thinking employee benefits are a little more, I won't say esoteric, but maybe to someone who hasn't had this class or isn't like in the weeds with it, it might be a little nebulous. But here, and up until this exam, it's mostly cash or things that can be easily liquidated. Okay. Adding to that, today we'll talk about stock options. Now, I mentioned stock options a little bit last week and saying that, well, it could be a good way to incentivize employees, and that's true. It could definitely be a good way to incentivize managers or executives, right? Because their job, all of our job, I guess, as a firm, but their job is specifically to steer the company to be profitable. That's usually what we look at for most CEOs. So what I want to do here in this chapter is go over quick definitions. You guys know I love the advantages and disadvantages discussions. So I'll go through that. Some of these could be pretty good test questions, FYI. Again, tax implications. And then I have two frequently asked questions that I'll leave to you again. And then by the end of this week, I'll have the answers to those and the previous questions. Okay. So we'll move through chapter 6. It's a bit short, but good material, good information nonetheless. So what are stock options? These, unlike kind of bonus plans, these are far more formal. So one of your questions is, what's the advantage of a written bonus plan? Okay. But stock options are far more formal. They're written. And usually, it provides an employee an option to exercise, should they see fit, to purchase stock from the company. It's usually at a discounted rate. So if the price right now is 100, you can buy it at 10% less, so you can buy it at 90. Or it could just be a set price. If you're thinking ahead, then you're saying, well, that's probably how we value that for taxation purposes, and you're on the right track. Okay, it's that net difference. And again, they're often used to compensate, and we say incentivize, right? Incentivize executives. Now, where do these stocks come from? So it's not like we're offering the chance for you to buy stock in a competitor or an unrelated firm, and then we'll just pay the net difference. No, it's in our firm, in our company. So Microsoft isn't going to give you Apple options. Ford's not going to give you Tesla options. It's within firm. Could be a subsidiary, but it's often within firm. Because how incentivized are you if your stocks are held in a competitor? Okay. Now, when do we say that this is a stock purchase? Okay. So the first thing before we get to this little bit of verbiage here is just because you go and buy stock in your firm doesn't mean that's an option that they're offering you as part of your benefits. They're a publicly traded firm. You can buy. You don't have to work for them. Okay? It doesn't have to be. If you do work for them, it doesn't have to be necessarily an option. You don't have to use that contract to buy. You can buy it on the market. In fact, if they are giving you stock options, but you still have a separate, let's say, 401k, that 401k could also be partially invested in your firm as well. Because usually the 401k, it might have a conglomerate of numerous different funds, okay? Some mutual funds, and there are plenty of mutual funds that would have Ford in there, or Disney, okay? Whatever your employer may be. Now, so beyond that, right, just to be clear, what we're talking about here is the contractual side of it. You are going to your employer and you're taking this option to buy it at the agreed upon price. This is not you just going out on the market and buying. Okay, this is contractually through your employer. So when an employer wants to compensate employees, okay, so you kind of need that. If you're the advisor, and you have a small or privately held firm that you're helping, they probably won't want to do this. And if they're moving to it, then you need to make sure that they're aware that what they're doing is giving up ownership. That's what happens. Because the firm, we can raise cash. Well, two ways that we can raise cash are through stocks, and what's the other way? So stocks are equity. We're going to go on the debt side of things. What's a general way that we as firms, what can we offer that's debt? Rhymes? Yes.
Bond.
Exactly. Yeah. And there are other avenues, but let's just say we're looking at stocks and bonds to raise some capital. Stocks, we're giving up ownership. Bonds, it's just debt. So traditionally in finance, there's what we call the pecking order, and you've probably heard this before. So if we look at stocks and bonds, as a firm, we say, what's the pecking order? So what we want to offer first as a firm? Do we want to offer bonds or stocks first? So think about it this way. Do you want to give up ownership, or would you rather just owe a little money? What do you think most firms would prefer to do? Give up what they have worked hard to achieve, or just take on a little more debt? Probably the latter. Okay, so generally, when we're speaking from the pecking order, we want to offer bonds first. Now, is this always the case? No. But generally, we want to offer debt. So when we're looking at a small or closely owned firm, make sure that they know that. If you, again, find yourselves in the advisor role. Because keep in mind, we're looking at this from three perspectives, always. And we're just shifting lenses or putting on different shoes, whatever euphemism you like to use. But one of those in the back of the mind is always an advisor. And I'm not saying all of you want to be advisors. That's fine. You don't have to. There's still personal value in this. You could run your own business. You could work for a private or a small business. So just keep that in mind, giving up that ownership. Smaller firms might not like, or closely held, they don't have to be small. Closely held might not want to do that. But that's why we tend to see executives be on the receiving end of these. We don't mind if they own a little bit. The board tends to make decisions. Now, I say incentivize, but just to clarify, that means, okay, if the firm does well, their market value increases, then so does the compensation of the executive or the employee. So that's where the incentive comes from, just in case. So it's good to clarify that, but we're probably mostly aware of that. So that's when would be good to perhaps use this, or to not use it, right? Now, advantages and disadvantages. So the advantages here, you can kind of design them. I won't say it's not free form. Yeah, when we're talking about accounting and IRS, I'm never going to use the word free form. But it's not quite as stringent, and it's a little more open in how you design it. So there's no real finagling that's going to change how it's treated on the tax side of things or on the formulation of the plan. I'm not saying those aren't intricate and detailed, but no matter what you do, you have plenty of options. They have no direct out-of-pocket expense. Again, what are you doing when you're offering this? This is equity. You're offering up ownership. That's not an accounting cost, but you might see it as something you're giving up. The expense would be whatever net. So if you offer them to buy it at 10% lower than market price, and it's $100, then your expense is $10 per share. And there are some standard tax deferrals, but it still ties back to when these options are accepted and taken. The disadvantages. Now, what you're doing here, you're not giving, so we think about 401k or HSA or bonus plans and compensation. You're just giving your employee money and or options. You're not giving them risk, really. Yes, the 401k funds are invested, the HSA funds can be invested. But you're still giving them that option, and oftentimes you're matching the proportion of that. So from the employee perspective, there's not as much risk. And even with things that do bear some market risks, like retirement, you can not do it. You can just dig a hole in the backyard and throw money in it. You'll lose more often than not doing that, but you'll never have zero. So what's happening here is that we're saying here's this nice security, this market instrument. And what we're saying is if you do well, this does well. Maybe. More often than not, that's kind of true. But the market is very noisy, very noisy. And some of that risk may not be specific to that firm. So we're moving out of idiosyncratic risk. It could be that it's systemic or systematic. We won't delineate between the two in this class, but it could be that it's a true market risk. And how much does your CEO have to do with the full market risk? Probably not much. So that's one thing that's different about stock options compared to what we've talked about to this point, and really what we'll talk about in the future. Is there's some risk being shifted on. Now they have a safety net, and that safety net is that difference that you're offering them. So if you offer them at 10%, lower the market price, they have a 10% safety net. Sure. But there's still risk. It could drop below, let's say, that $90 value or 90%. It could drop below that. So that's kind of the biggest kind of con. The source of funds, so the employee still has to be able to buy it. They have to come up with cash to buy it. With a 401k, they just say, I want to put money in. They have to come up with the cash. But if you offer a match, and let's say it's a 5% match, or 100% up to 5%, then you're still getting, quote unquote, a free return there. You make $50,000 a year, that 5% match would be pretty nice. So you get $2,500 a year. So, another thing, going back to this market thing, it might not have anything to do with performance. I think I've already covered that, but it is somewhat separate from just bearing the risk. And that tax deduction we mentioned earlier is only till the option is exercised. So you can't say, look, we're giving them 10% off on all this stock, so we want to count all that as an expense. Well, if nobody takes you up on that, then there's no real expense that's been accrued. So this is on an accrual basis. You haven't accrued that expense. It has to be purchased. And so it's pretty limited. After that, yeah, sure. After they exercise that option. So speaking of some tax implications, let's look at the employee. So for an employee, if we can't determine the value, so it might be better that if we can determine the value, it's mostly that net. Okay. But if it's not readily ascertainable, we won't count it as taxable income because we'd just be guessing. This might be true for an IPO for a small firm. So if we can't ascertain fair market value. Now, otherwise, so the employer does have taxable income when they are purchased with a known value. We can ascertain that value. But the taxable amount, as I said, again, is that net, which is called the bargain element. Good example, market price is 100. You can buy it at 90, $10 per share. Buy 10 shares, $100. That's the expense. That's what the employee is giving you. That's an expense for them. So they're giving you that ownership lower than what the market values that ownership. That's what you're getting out of this. For the employer, if I'm an employer, I don't get a tax deduction during that, not when it's granted. Okay, it's again when it's exercised. And that was in the kind of the disadvantage column earlier. So the cost must be incurred. So this is accrual based. So kind of covered that, but I think it does need a separate slide. So what do we mean by fair market value ascertainment? So some things that can limit us there. So if it has a readily ascertainable value, we can then tax it at that point. And the employer gets that net deduction. Okay. And that's mostly the norm. It's most of it. Now, it's required that we know the value when it is granted, and it needs to be able to be traded on an established market. And really, if we think about it, if it doesn't meet these two, what value is there associated with it? It's a huge gamble. It'd be very frustrating to, as an employee, to pay taxes on something that's not worth much. And again, it's guesswork. Now, after the fact, if you purchase more stocks, and let's say we can ascertain the value after that, then we're back into this realm. All right. So let's leave you here. These short 2 common questions, just something to think about, and I'll provide you the answers to these. Could be a good pack-back discussion. So the first one is, how do security laws affect these? The short answer is a lot. So almost any law pushed forward that has to do with securities, market value, or equities affects these. The second one is like, all right, well, what then is happening on the accounting side of things? It's beyond the standard balance sheet. Okay, all right, well, given up equity, there's expense tied to it. How do we expense that on the income statement, right? So it's beyond just basic income statement and balance sheet. Because we talked about that accrual setup. So think about, and again, I'll give you these later. Think about what securities laws would mean for these. How's it different? Because we're getting this below market rate. Is there a chance for arbitrage? What's the treatment there? And then internally, how is a firm going to treat these options that it's giving its